Hey, it's Trent Krinkmeyer with Krinkmeyer Leonard Financial, and today I'm going to talk about when do you pull the trigger? When do you rebalance your portfolio? When do you get out of a highly volatile stock market or bond market or currency market like we're seeing today? So in this video, I'm going to take you through some things that I consider to be indicators of when to and when not to rebalance my portfolio. So let's get going. First thing, if you were driving down the road at the speed limit or 80 miles an hour, whichever speed you drive, would you open the door and voluntarily jump out of that car? Chances are, if you are of sane mind and are in a solid state of mental clarity, you're not going to do that. Well, the stock market's the same way. Jumping out of the market as it falls in a rapid rate like we're seeing recently is like jumping out of a high-speed bullet train moving at 300 miles an hour. You're going to get hurt and you're going to make a bad decision. First step thing I look at is the Volatility Index, or it's also referred to as the VIX, which is the Volatility Index for the S&P 500. What this tells me is how much anxiety or stress or fear is in the market, and vice versa, how calm the market is, how content the market is. And as you can see in this chart, over the last 3 weeks, we have seen the VIX skyrocket. Yesterday, on March 16th of 2020, we saw the VIX close at its all-time highest of 82. 82 is ridiculously high. So anything over 30 is a point of we make no decisions. We just stay still. It's like you see those horror movies where the horror person or the scary person walks in and everybody just says, just sit still. That's what we're doing right now. We're in a horror movie to an extent, and we're seeing the VIX jump. So when I see the VIX jump, I stop. I don't make any rash decisions because I know at some point that VIX number is going to drop. And when it gets closer to 30 or so, and remember the average is probably around 15 or so on a long-term basis, average meaning market's content, market's moving up, there's a low anxiety overall. So VIX at 82, it's a no-go zone. Don't do anything. This is when you sit still and let that crazy nightmare person in that horror movie get out of the room. So the second chart I look at is what is called the CBOE, Chicago Board of Options Exchange, put to call ratio. So let me give you a quick, what is a put and what is a call? These are called derivatives, and what they are short-term contracts that people can use as quote-unquote insurance to hedge their portfolio or allocate little dollars to an anticipating that maybe the stock market goes up or down. So what I use the put to call ratio for is to tell me, are people buying calls in thinking that the market is going to go higher? So there's complacency, there's confidence, they believe in the market's going to go higher. But when they buy puts, they believe the market is going to go lower. So as you look at this chart, you can see where over the last 3 weeks, the put to call ratio has spiked to the upside, meaning there is fear in the market. It's way out of its weekly or monthly average. So fear is super high, super anxiety ridden. And this is one of those indicators I look at and go, people are freaking out. This is another indicator to say, sit still and be calm. All right, so last but not least, this is one of my favorite indicators because it represents the biggest market on a global level, and that is the bond market. Specifically, what this chart is showing is the MOVE index, MOVE index. And what it represents is the volatility within the U.S. Treasury market, in particular the 10-year Treasury. And when this index moves, typically it is very a leading indicator that people are now really fearful. So think about this. When it comes to stocks or bonds, when you think things are risky, you buy bonds. And when you think things are safe and positive, you buy stocks. You build a portfolio of bonds and stocks because a combination of that will manage your risk overall. So when I see the MOVE index jump like it has over the last 3 weeks, it's an indicator to me that people are fearful. They're going to the most secure asset in the world, and that is the U.S. Treasury market. And you can see that through the MOVE index here. So look at these three indexes as a barometer or a measurement of what the fear factor is. On the flip side of things, when markets start to settle out, which they will at some point, when the coronavirus starts to settle down, when fear comes out of the market and all the mass selling is done, you will see all three of these indicators come below their what I call target rates of where I want to enter the market or when I don't want to enter the market. So as I watch these, I will then make decisions on how I allocate portfolios going forward. But most importantly, I'm not going to jump out of a moving car at this point in time because I'm going to get really hurt really badly. All right, so I'm going to give you 3 things you need to do as we move through this market and honestly through any market, any conditions. Number 1, breathe. Relax, take a step back, and don't make an emotional decision. You're going to make bad decisions. When we get heated and we get frustrated, we say bad things, which hurts relationships. Think of the stock market the same way. You got to chill out, you got to calm yourself down, take a deep breath, and relax. Number 2, understand your risk tolerance. What are you truly capable of withstanding when it comes to volatility in the stock market? You may say you're an aggressive person, but when the market drops 10% in a day, are you freaking out? Are you losing it? If you are, maybe you're not an aggressive investor, but maybe you're rather a moderate or a moderate conservative investor. Either way, you're investing to get to an end point. So understand your risk tolerance. And number 3, indicators such as the VIX, the put to call ratio, and the MOVE index. Now I know for a lot of people that is just over their heads. I totally get it. And that's why you use an advisor who understands these kind of things. If you are not a client of mine, I would be more than willing to help you and to understand your risk scenario, where you are risk tolerance wise, because I believe it is so important for you to chill out and be calm at this point. With that said, I'm going to leave my information on how to contact me. If you have questions, feel free to reach out to me. I have blocked out the next 3 weeks, Tuesday, Wednesday, Thursdays, 9 o'clock till 4 o'clock, 20-minute intervals to talk to people on the phone about their concerns about the market, about their portfolios, and the amount of risk they're taking. Please use me as a resource. In the end, be calm, be cool, and most importantly, live life loud. Peace.